My name's Paul Misn. I'm a Professor of Monetary Economics at Nottingham and Chairman of the MMF. And I was kindly asked by the organisers to chair this session. Let me introduce the next speaker. The next speaker is Kent Matthews. He's going to talk about, is inflation caused by deteriorating inflation expectations or excessive monetary growth? And that paper is written with Kian, Howe, Ong. So Kent is well known to us. He began his academic career on the Liverpool Macro Research Group and helped to develop the first rational expectations model for the UK economy. He was also the principal forecaster for 10 years before he moved to Cardiff Business School. And it seems he's oscillated between Liverpool and Cardiff throughout his career. He returned to Liverpool to take a chair in banking and finance at John Moores University, then returned to Cardiff to become the Sir Julian Hodge Professor of Banking and Finance. Kian Howe Ong is his co-author, and he was a student at the University of Nottingham, where he gained his PhD. And he spent time at the University of Melbourne and various campuses of Nottingham University. So Kent, you've got about 25 minutes for your paper.
Thank you very much, Paul, and thank you for the organisers for inviting me to give a talk here at this conference. And thank you to Gail for organising the proceedings. Now, unlike the talk that John gave earlier and the talk that Tim's going to give with Juan following me, which the title of their talks starts with on, the monetary growth and inflation, or on the 2021 surge in the amount of money and return of inflation, which, starting off with the word on, gives them a great deal of latitude on what they discuss, whereas Tim Congdon gave me a very clear and explicit question to answer. Is inflation caused by deteriorating inflation expectations or excessive monetary growth? Now, that seems to be a very clear question, and I'm going to try and address that question. So what's behind this question? Well, I have to take you back to a longer and older debate, which is about the debate between the monetarists and Keynesians, which started in the 1960s, which started with the work of Friedman and Meiselman and the work of the St. Louis Fed, Anderson and Jordan. And this was all about the debate about whether you should model the transmission mechanism through a structural method of modeling the economy, a structural form, or a reduced form, which just simply looks at the exogenous variables and whether that drives, the key endogenous variables. Now, Friedman and St. Louis Fed and others who had a monetarist persuasion argued that really, actually, the way money affects the economy is too complicated to try and model in any kind of structure. And what they said was that the kind of analogy they gave was the sluice gate analogy of the farmer that would open the sluice gate to allow water to enter into the farmer's field, to irrigate the field. Now, the way the water comes in, it comes in through all different ways. And it may not come in through the same way each time you open the sluice gate. And so it's very difficult to model that. And in fact, it's much better to model it as a reduced form, where you know that water is the equivalent of that is in the economy is the money supply. As that comes in, that goes through all the different channels, which you can't model. But what you do know is that in equilibrium, water has found its own natural level. And that is when the money supply affects nominal GDP. And in the long run, there's a relationship between these two. Okay, so now what underlying behind that also is this kind of notion that the real economy will tend to some equilibrium. And ultimately, when money feeds through into nominal income, ultimately that affects inflation. And that's what underlies the old classical view of the neutrality of money. Now, since the acceptance of inflation targets by central banks, the reasoning has been that if you can influence expectations, you can cut through all these channels that way money affects the economy. You cut through that by affecting the variable that directly impinges on inflation, and that is inflation expectations. And somehow, if you work on that, you can anchor inflation expectations through a credible monetary policy, and that then determines inflation. So where does this expectations come from? It's like a magic. And actually, I came across this quotation from a paper by Jeremy Rudd that's quite recent, which tells us that somehow, if expectations is some sort of magic, those of us who don't believe in magic, as John Hicks here says in this quote, we want to know how it got in, all right, into the box. Well, we know that expectations must matter, but the question is, where do they come from, and how is it measured? Well, there are three interrelated questions that relate to the topic of my talk. First, what kind of theory underpins inflation determination? Second, what kind of theory determines expectations of inflation? And third, what is meant by excessive monetary growth? Now, in the last talk, John Greenwood gave some assumptions of what he thought was excessive monetary growth, but really we can actually appeal to Patinkin's early work on the real balance effect, which gives a rigorous formulation of what we mean by excessive monetary growth. And that comes out as there's an equilibrium demand for money, an equilibrium where if there's an excess amount of money, that's excess to that equilibrium, people get rid of that money by spending. They pass it on to others, and that has this passing on to others means that other people have more money than they want to hold, and they pass it on to others, and so on. And ultimately, that affects the economy as this money keeps getting passed around. So here's a possible channel. And I hasten to add that Friedman didn't provide this channel. I mean, because Friedman originally said that the channels are too difficult to actually model, but here's one that many monetarists would accept. We start on the left-hand side with a disequilibrium between the supply and demand of money, and this disequilibrium affects financial markets, because if there's an excess amount of money, this works into financial markets as people buy assets. That's very Friedmanite. They can go into the goods market through expenditure. That's very much the real balance effect. I can buy real estate. And all these things then feed into money GDP. And ultimately, money GDP is split between inflation and real output by the missing link, which is Friedman told us in his presidential address, is the expectations augmented Phillips curve. Now, in the long run, real output is supposed to tend towards some equilibrium. And for those of us, those of you who attended Lord King's lecture, the IIMR annual lecture a week ago, he said this was a questionable assumption. However, it's an assumption that the classicals held for a long time, that real output tends to some equilibrium. Therefore, then all of money, monetary excess money feeds ultimately into inflation. So that's a possible channel. And I'm not suggesting that's the only channel, but this is something that we can work with. Okay, now let's turn to expectations. Here I've explained, I've drawn a diagram here of expectations on the vertical axis. We have exogenous expectations, which you can think of as sort of Keynesian or animal spirits. And on the horizontal, we have endogenous expectations, which could be rational expectations of Lucas. And in between, we have the sort of models of expectations that people have used in the literature. There's inelastic expectations, which is expectations that tend, it's mean reverting, that tends to some kind of long run view of the world, or an expectation that always has been around. So there's a tendency to go back to it. There's adaptive expectations, which of course we're all familiar with, which is an error learning type of mechanism based on past outcomes. And then we can have Bayesian expectations, which is a sort of a rational learning, which takes a little bit about adaptive expectations, but takes in new information other than just past behavior. And then we have rational expectations, which takes in all the available information. Now, what do these expectations do? As we move from top to the bottom here, it introduces extra dynamics into the system. Okay, so the adaptive expectations introduce extra lags and extra dynamics. The Bayesian expectations are a little bit of forward-looking and a little bit of backward-looking. That also introduces some more lags and dynamics, but also because it's forward-looking, it enhances the effect of monetary policy. Okay, so that monetary shocks then, instead of working its way through the system through a long process, can have a much more immediate effect. So it accelerates, it has an acceleration effect. And ultimately with rational expectations, of course, the acceleration effect depends very much on whether the monetary shocks are expected or unexpected. Okay, so let's go back to our possible transmission mechanism here. Inflation expectations here then enter into all the behavioral functions that underlie all these boxes. Now, the demand for money and the financial markets, how it affects financial markets, the demand for financial assets, demand for goods markets, the demand for goods, demand for real estate. And so inflation expectations works through all of them. And so you can understand why central banks think, well, we don't really need to know about all this bit, about all the transmission mechanism. All we need to do is work on inflation expectations through a credible strategy, and then that will work directly into inflation. Okay, so now let's turn to the monetarist perspective. And I've put out a few quotes here by Friedman, which you've already heard from John Greenwood's earlier talk. Inflation is always and everywhere a monetary phenomenon. Inflation is a steady and sustained rise in prices. Now, this also is relevant to the discussion that John Greenwood made about relative prices, because then inflation is not about productivity shocks or changes in preferences or natural disasters like pandemics. It is a steady and sustained rise in prices. In the quantity theory restatement, Friedman also says that the income velocity of money is stable and predictable. But in his theory of nominal income, he says the relation between changes in the nominal quantity of money and changes in nominal income is almost always closer than and more dependable than changes in the quantity of money per unit of output and changes in prices. Why? Because somewhere else, Friedman says the lags are long and variable. Okay, so let's take, first of all, this relationship between the changes in the nominal quantity of money and the changes in nominal income. From his theory of nominal income, what I've done here is for the UK, I've taken a 6-quarter moving average of the annual change in nominal GDP and M4. Okay, so the red line is the 6-quarter change in M4, the 6-quarter moving average rather, change in annual change in M4, and the blue one is the same for nominal GDP. And what you can see is that, you know, there's a correspondence here. And in fact, the more you smooth it, the greater that correspondence. And of course, that's the trick that Friedman did when he was using the data, the long series of data with Anna Schwartz. He was actually smoothing out over the cycles. And when he did a smoothing of over the cycles, he got a very strong correlation. Now, this correlation is actually 0.6346. And as you smooth it out and make it an 8-quarter moving average, the correlation increases. So if we go from a 1.5-year moving average to a 2-year moving average, to a 3-year moving average, to a 4-year moving average, what we're doing is we're smoothing out the cycle, which is the trick that Friedman did. And in fact, Friedman reports a correlation of 0.99, okay, in his work. So you can see by smoothing, you get a very strong correlation. But what we do know is that correlation is not causation. So to get to that, we need to turn to the data. So can the data help to resolve this issue, or rather resolve this question that Tim Congdon set me? Well, I'm using data for the UK from 1972 to 2021. And the answer, as always with empirical work, is yes and no, because, yes, it answers some of the question, no, because there's always more questions that come about. But I'll give you what we have obtained so far. I use 2 measures of inflation expectations, which I get from the Bank of England online database. And this is a combination of survey data and NISA forecast for 4 quarters ahead for inflation expectations. So I call that short-run inflation expectations. And then I also get the implied market inflation expectations from 5-year index-linked yields from 1995. And thanks to John Greenwood for getting this data for me. But to go backwards, I've assumed a fixed real rate of 3.5 for the previous quarters and then backed it out. So now this is sort of a synthetic inflation expectations for long run inflation expectations. I use the word synthetic as another way of saying I made it up, but it looks pretty interesting, and I'll show you the chart in a moment. I also have quarterly broad money and quarterly nominal GDP. Okay, so here are the measures of inflation and inflation expectations. The black line, that's inflation. The red line is the short run 1 year ahead inflation expectations from the Bank of England data. The green line is the one that's backed out from the 5-year bond yield and also from 1995, what's implied from the real yields, equivalent real yields, the same maturity. And you can see that, there's a sort of correspondence. You can see that the long run inflation expectations are not as volatile in this noisy inflation period of the 1970s and the early 1980s. And, there's a correspondence for all these 3 measures for the quiet inflation period from about 1983 onwards. Okay, so where do we go from here? Well, here, as I said, we take these issues to the data and we conduct a VAR. We estimate 2 models and the Cholesky ordering follows very much the theory that I set out in that earlier flow chart. So following the theory, we go from N4 to inflation expectations, to nominal GDP, to inflation. And model 1 has short-run inflation expectations there for the inflation expectations data, and model 2 has the long-run inflation expectations data. We actually examined the full period from the 1970s through to the current period, and that includes the noisy inflation and the quiet inflation periods. And the results we have are available, but we want to concentrate on the quiet inflation period, and we first of all undertake some Granger causation results. Okay, so here are the results for the Granger causation, and what I want you to concentrate on are these red numbers, which show you that these are significant and you cannot therefore reject Granger causation. What's interesting, first of all, for model 1 is that M4 is not caused by any of the other variables, but M4 here has an effect on inflation. Sorry, M4 is not caused by anything else, but in fact, you can see that it has an effect on inflation and on inflation expectations. With model 2, there's some two-way feedback from long-run inflation expectations to M4 and M4 to long-run expectations. But the story, that's a slight curiosity, which I'll leave there to think about. But I think it's easier to understand these statistics through a visual interpretation. And the visual interpretation here is that with model 1, M4 causes inflation statistically, and M4 causes inflation expectations. And then there's a inflation and inflation expectations work on each other to cause each other. And with model 2, we have M4 causes inflation, and M4 causes inflation expectations, but inflation expectations also feed back onto M4. And there doesn't appear to be any significant link between inflation and long-run inflation expectations. So the next thing we do then is we conduct some impulse response functions, and we look at model 1 and model 2 separately, and we do a shock to M4 to ask what happens to inflation and inflation expectations. Okay, so this is an IRF with a shock to M4. And what you can see here is that there is a significant, you can see these red line, dotted lines are the two standard errors from the point effects. And you can see here that this is significantly different from 0 for the effect of a shock to M4 on inflation expectations here and here and here. So there's some effect of M4 on inflation expectations. But here's the result for the effect on inflation. You can see from about the 6th quarter, all right, that's significantly different from 0. There are positive effects on inflation up to about 16th quarter. Okay, so this IRF shows that M4 drives inflation and inflation expectations. Now, what about a shock to inflation expectations? Well, you can see here there's nothing much going on, for nominal GDP, and no feedback effect onto M4. But you can see it drives inflation up to 10 quarters. This is significant, up to about 10 quarters here. Significant positive effect of inflation expectations on inflation. We can also get a picture of the longer run effects up to 20 quarters here when we look at the variance decomposition of inflation. And what we have here is the orange bar here is the 1 year ahead inflation expectations, the short run, and the blue one is M4. And you can see in the short run, inflation expectations has a strong effect on inflation, but over the medium to long run, it's the money supply or M4 that's doing that. It dominates. IRFs from model 2 show a somewhat similar picture. And we can see here that the main thing is that inflation is being driven by M4 from the 6th quarter here. You can see from the 6th quarter to about the 16th quarter. That's a significant effect. So the lag that John Greenwood talked about, that's being shown up here in these IRFs. So we are talking about an impact effect of about, in this case, starting from about 6 quarters, and in the earlier one, starting from about, yes, the same, about 6 to 7 quarters. Okay, so again, with model 2, the variance decomposition shows the same sort of story, that in the short run, we got this orange. Long run inflation expectations has an effect, but it's very small, actually. It's very small. Most of it is M4, and over the medium to long run, M4 dominates. Okay, so what's the results and conclusion of this statistical exercise? Well, what we found is that inflation expectations has an influence on actual inflation, but inflation expectations is not independent of the money supply. Shocks to M4 drive both inflation and inflation expectations. And the variance decomposition of both models show that the variance of M4 dominates in the medium term. So to answer the question that Tim set me at the beginning of this talk, it's not an either or. All right. In conclusion, both the money supply and expectations drive inflation. In the short run, inflation expectations dominate. In the medium to long run, it's the money supply that dominates. So that's the end of my talk, and I will await your comments.